Hey everyone, Starbucks reported fiscal year 2024 third quarter financial results that investors appreciated. The stock price is increasing following this update. I'll review the latest figures from Starbucks and highlight the reasons why the stock price is rising. I'll also update my buy recommendation of Starbucks stock, and I'll let you know if I think the stock is a buy following these earnings results. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starbucks reported global comparable sales that declined 3% year over year. This was driven by a 5% decline in comparable transactions, offset by a 2% increase in the average ticket. This means people visited Starbucks less often, but when they did visit Starbucks, they had to pay 2% more. That's most likely because prices were higher compared to the same time the prior year. In the US specifically, comparable store sales declined by 2%, driven by a 6% decline in comparable transactions, partially offset by a 4% increase in the average ticket. Again, higher prices and lower visits. And this is now the third big company I've noticed finally experiencing a decrease in customer visits as a result of higher prices. The prior two companies I'm talking about here were McDonald's and PepsiCo. PepsiCo and McDonald's have also been raising prices just like Starbucks in the last couple of years. And despite those price increases, they've experienced increasing customer transactions. But now in this current quarter, in the current earnings season, I'm finally starting to see customers pulling back. Customers are finally saying, no more price increases. You keep raising prices, we're not going to come anymore. We're not going to buy your products, or we're going to buy your products less often. And this wasn't happening up until this current quarter. This is just the beginning of the pullback as a result of higher prices. Now, customers have been complaining about higher prices for more than a year now as a result of inflation. But those complaints were not resulting in lower comparable store sales. Now they are. And the Starbucks management team talked about a customer that's more cautious now, a customer that's not just accepting these price increases. Comparable store sales in China also declined by 14%, and this was driven by a 7% decline in average ticket and comparable transactions. The economy in China is not doing as well as the economy in the US. It hasn't recovered as robustly from lockdowns like the US economy has. The property sector there is in big trouble, and consumers are more cautious. On top of all that, competition is more fierce in China than it is in the United States, and it hasn't been easy going for Starbucks in China over the last few years. Now, the company did open 526 new stores in the third quarter, and it ended the period with over 39,000 locations. Now, Starbucks operates on a half and half model. It owns half of the stores it operates, and it outsources half of the store, or it licenses half of the stores. I would prefer if it had a larger percentage of licensed locations. That would generate better profit margins. It would also allow the company to grow more efficiently because it wouldn't have to use its own capital to open new locations. And for the most part, when a franchisee owns a location, they tend to operate it better than if Starbucks owns the location, because those franchisees have a greater incentive to make sure those stores are operating efficiently, whereas Starbucks might have tens of thousands of stores, and a manager that's operating the store is not as likely to put his energy and imagination into those locations compared to a person that owns the location and is responsible for all the profits and losses in that location. For that reason, I tend to favor the licensing or franchising business model here with these types of businesses like Starbucks and McDonald's. I like the franchising business model. Overall, consolidated all-included revenues declined by 1% to $9.1 billion. Also, its operating profit margin fell by 60 basis points to 16.7%. This was due to increased promotional activity, investments in wages and benefits, and of course, when you have lower sales, it hurts your profit margin. Now, the area of concern here is the increased promotional activity, because the company's revenues declined, comparable store sales declined, even though they were offering more promotions and more incentives. That's not very good news. That's not very good news because that signals that organic demand for Starbucks products were really low in the latest quarter. Now, in one sign of good news, Starbucks Rewards loyalty program 90-day active members in the US were up by 7% to nearly 34 million. These loyalty rewards members are really lucrative for Starbucks for several reasons. For one, because these members usually have the app and they are logged into the app, and so when they order, they are more likely to order from the app than they are in person compared to a non-loyalty member customer. And when a customer is ordering from the app instead of ordering in person, that's a more profitable transaction for Starbucks because taking an order via the app is less costly for Starbucks than taking an order in person with a person taking that transaction, inputting the order. And so the more people on the Starbucks loyalty rewards program, the more profitable for Starbucks. Second reason for that is because when there is a promotion or when they do want to increase promotions, they're able to do that most efficiently through the app or through an email instead of having a national advertising campaign to let everyone know that Starbucks is offering 50% off on Thursdays between 12 and 6 p.m. They can just send that email or send that notification through the app, and that's less costly for Starbucks. So for those two reasons and some more that I won't mention, I won't go into too much detail, but the loyalty rewards program growth is great news for Starbucks stock investors. So the CFO saying that their efficiency efforts are tracking ahead of expectations, and these are offset by investments associated with the cautious consumer environment. In other words, they're lowering their costs and they're getting better at operating the business. However, customers are becoming more cautious. They're not spending as robustly as they were previously. As I highlighted earlier in the video, they're saying no to some of those price increases. They're saying, you know what, if you're going to raise prices by that much, I'm just going to make my coffee at home instead of coming to you and paying you your $5 for your coffee. So it's pluses and minuses for Starbucks. It has not been a good year for Starbucks. As I highlighted earlier in the video, I would update my recommendation of Starbucks stock. Now, as you'll recall, if you've been following the channel, I had Starbucks stock rated as one of my top stocks to buy this year, but I downgraded it off my list of top stocks to buy around May 2nd. Still, to update my buy recommendation for Starbucks stock is trading at a forward price to earnings of 19.52. And I think the foundations of the business are strong enough to weather this headwind of consumer changes and come out on the other side still a strong and robust business. So I would reiterate my recommendation. I still think Starbucks stock is a buy, while acknowledging that the near term is going to be difficult for this coffee giant. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.